your chart before even market opens. Now we will come to the topic how to prepare your chart before market opens. Okay, you have to prepare your chart before even market opens. Market opens at 9:15, but that doesn't mean that you will open your laptop or computer at 9:15 and then start thinking, should I buy or sell today? What should I do? If you are a professional trader, you have to mark important levels on your chart, important location at least 30-45 minutes before market opens to know where is the support, where is the resistance. For that, you need to do the chart analysis based on multiple time frame. For example, first thing, what you should mark: previous day high, previous day low, also known as PDH, PDL, and previous day turning point. For that, you can go to 5 minutes time frame. You don't have to go to higher time frame because it is just a previous day, right? You can see it only 5 minutes time frame. Why PDH, PDL important? Because I said for a day trader, previous day plays important significant role. So that is why PDH, PDL important. PDH, PDL very easy to market. For example, Monday market opens like this, goes up, and then 3:30 market closes here. This is your previous day high. This is your previous day low, right? For the next day, this is your important level. This is your important level. That is the PDH, and this is the PDL. So it is easy to mark. There is no confusion. But only thing is that many people don't know about this turning point. What actually turning point? Turning point is something like that. Market is going up like this, then it stayed sideways for a very long time. Why it is staying sideways? Assume that there is some important resistance. It's going near that resistance and coming back. And finally, somewhere in the afternoon, breakout happens and market kept on going up. So this is what your turning point. Turning point means price where breakout happened previous day. Or market started coming down, then stayed sideways because maybe there was some support. Every time it came near that support, and finally market went down. Breakdown happened here. So this is your previous day high, this is your previous day low, this is your turning point. You can mark this also. Okay, this is also likely to work as a strong support resistance on your chart. Sometimes you may see a huge trending day previous day. Previous day was a huge trending day. This is the previous day high. This is the previous day low. Now where is the turning point? There is no turning point because there is no breakout like that previous day. It was a trending day. So you will not mark it. So that means turning point you don't have to mark every day. Sometimes it may happen, sometimes it may not happen. Or sometimes market is staying sideways till 3:30. For the next day, you mark previous day high. You mark previous day low. Where is the turning point? No turning point. So that is why PDH, PDL, yes, it is mandatory that every day you have to mark it. Turning point only whenever it happens. Other times you can leave it. Next one about the supply and demand zone. What is the supply and demand zone? Supply and demand zone is nothing but where market turned from bullish to bearish or bearish to bullish. Suppose you see that Nifty is going up very bullish for last 1 week. It is going up every day, and suddenly one fine day it crashed. Suddenly it crashed. This is what your supply zone. This is where market crashed, right? So that becomes supply zone. That means market was going on bullish mode, then crashed. So that becomes your supply. Suppose assume that market came here, made a base, and again started going down. So this is your demand zone because this is where after bearish mode market turned bullish. And this is the place you should know that selling pressure likely to come. Okay, you may see a reversal from here, but anything can happen. Breakout also can happen, but most of the time you can see reversal from here because this is the supply zone. From the supply zone, market keeps coming down. When it comes back to the demand zone, there is a high chances that it may take support and it can bounce. Okay, there is a probability of bouncing higher. That is what supply and demand zone. That means only you have to see where market crashed or bounced. For example, you see that market is going up like this. This is not a crash. This is not a crash. This is a retracement. Crash means how it happens? Like this. This is a crash. Collapse. This is not a retracement. Bounce also, market is going down, but it is bounce, small pullback. But sometimes you will see suddenly it start going up. So this is your demand zone. Okay, I'll show you on the chart so that you'll understand much better. But remember, time frame is not really important here. It's not that you need to have 5 minutes, 15 minutes, 30 minutes, but it can be 5 to 30 minutes, because in the PDH PDL what you will do, you will only see previous day, right? If 2 days back you don't have to mark, 3 days back turning point you don't have to mark, you only have to mark PDH and PDL and previous day turning point. But supply and demand zone even applicable, even it is 1 week back, 15 days or even 1 month back. So you can't see it if you go on 5 minutes time frame, because 5 minutes time frame on your chart you can see only previous day or last 2 days, something like that. You can't see 1 week back, 15 days back price action. That is why I mentioned you can go to higher time frame. Is there any supply or demand zone? Okay, so here not really time frame is important, but it can be 5 minutes, 15 minutes, but not daily time frame. Now for swing high, swing lows, for that yes, you have to go to daily time frame. For the gaps, for that also you have to see the daily time frame. Remember, gaps also one of the very important levels on your chart, along with swing high, swing lows. What is the swing high, swing lows? Let me show it. Daily time frame I said, right? This is your candlestick, daily time frame candlestick. Okay, it is going like this. And you know that most of the time every candlestick will have the wicks. Alright, candlestick will have wicks on the upside or downside or on the both side. Sometimes you may see huge wicks like this. Sometimes there can be small wicks. Okay, assume that this is the price action. 3 days market was going up, or 4 days, whatever it is. After that market started coming down. Again market started bouncing after 3-4 days. Right, and again it's going up. Now you know which is your swing high and swing low. Here also let us mark swing low. Here also let us mark swing low. Now you know which is the swing high, swing low. This is your swing high and this is your swing low. The extreme end, what you see, that is your swing high and swing lows, one of the important levels. Okay, this is not your swing high. Even though this candle is above it, this is not a swing high. You should look for that spike. Can you see that spike? Extreme end spike. And where extreme end spike, this is the extreme end, right? This is not extreme end. So that is what swing high, swing low. So next time you will mark that level. This is the swing high, swing low on daily time frame. This level likely to work as a strong resistance, and if price starts coming down, this level is likely to work as a strong support. This is likely to work as a strong resistance. That is what swing high, swing lows on the chart based on the spikes. Okay, extreme and spikes. What about the gaps? Gaps also, again you have to see it from daily time frame. For example, Monday like this, Tuesday also bullish day, Wednesday also bullish day. You know what? Wednesday night, some positive news came in the market, something positive related to economy, and market made a big bullish candle. That is what your gap. Where is the gap now? This is the gap. Gap is previous day high and current day low. This is what gap. Okay, this is what the gap. This is not a gap because next day candlestick inside that previous day range. No gap here, only gap here because next day entire candle outside the previous day high and low. Right, this is the previous day high low. So that is what gap up. Gap down is same. If there is a red candle below this candle, okay, below this candle makes a red candle, then it's a gap down. Why gaps are important? There are two things. They say markets don't like gaps. In technical analysis, they say markets don't like gaps. That means most of the time, not all the time, most of the time they say market tend to come back and fill the gap. If there is a gap, market tend to come back and fill the gap. That means not every time bullish mean market has to go up like this. Most of the time it comes and fills the gap. Second thing, I've seen gap borders also very important support resistance. What is your gap border here? This is the lower border, right? This is the upper border. Most of the time I've seen price comes down, takes the support before filling the gap, takes support here and again bounces. Later part it may come back, but this is what one of the support, this is also can be support. So that is what gap borders also very important. Finally, if you are a trader who trades in index for intraday I trade in mainly Nifty, Bank Nifty. My advice is better to have split chart, or if you have two monitors, on one monitor you can run Nifty, on another monitor you can run Bank Nifty. Why it is important? Suppose you are just a Nifty trader, you are trading Nifty, okay, then why it is important that you should look at the Bank Nifty? Let me tell you that. Okay, suppose Nifty on Monday, you see that Monday, I'm just giving example, it can be any day, okay? So just I'm giving you example Monday like that, but that is not like that, only Mondays. So you see that this is your CPR on Monday, and you can see that there is a pivot point here, S1 pivot. And assume that Monday market opened with a bullish candle, gap down candle, made a bullish pin bar, and you think that, oh, Nifty looking very bullish, let me take a long trade and book my profit at the CPR, and you must have kept your stop loss here. You know that CPR works like a magnet, so price gets attracted towards it. You went long, but instead of going long, market reversed, your stop loss hit. It didn't hit your profit target, but your stop loss hit, which was here. And what happened? You get upset. You got angry that your stop loss hit, even though there was no resistance, it reversed and your stop loss hit. Now, what would be the reason? What happens most of the time? Why it happens most of the time? Let me discuss. That is what I've seen trading in Nifty, Bank Nifty. Okay, Nifty, you know that you've taken a long trade in the first candle because there was no resistance. There was a space for it. There was a room for it to move to the CPR. So you have taken a long trade. But you know what? First candle in Bank Nifty right at the CPR. Even though Nifty looked bullish because there was no resistance until CPR, but Bank Nifty was already at the CPR. Bank Nifty suddenly reversed from the CPR. Nifty also reversed. That is what I say, moving in tandem. Nifty did not have any resistance. Just because Bank Nifty reversed, Nifty also can reverse. That is what can happen many times. So that means next time, don't take a long trade here just because Nifty showing bullish. See where is the Bank Nifty. Okay, Bank Nifty may have a resistance, Bank Nifty may reverse. Now you may think that, oh, it means every time Nifty follows Bank Nifty, nothing like that. It can be vice versa. Sometimes maybe Bank Nifty following Nifty. Bank Nifty doesn't have any resistance. You went long, but Nifty had a resistance, Nifty reversed, Bank Nifty also can reverse. Okay, so this is something you should remember this fact. Not all the time, but most of the time, yes. I will show you this in one of the chart as we go forward, where what happened, how it reversed, everything I'm going to show it. Okay, now I mentioned about all the locations, everything. Now, you may be thinking that so many things we have to mark. Our charts will look very bad. So many lines, PDH, PDL, turning point, supply demand zone, swing high, swing low, gaps. So many things, apart from that, daily pivot, weekly pivot, CPR, everything you have to mark, and you may think that it looks so many lines. Let me tell you one thing. Remember, you don't have to mark everything on your chart. If this is your chart, what are the things you have to, every day you have to mark? This is every day you have to mark. PDH, PDL, every day you have to mark. Turning point, only days whenever it is there. If it is not there, then you don't have to mark, right? Supply demand zone, you will not see every day. Only mark it whenever you see it. Okay, swing high, swing low, not every day. Only mark it whenever you see it on your chart. Gaps, not every day. So that means only thing compulsory you have to mark. That means only thing you have to mark every day. PDH, PDL you have to mark. Then CPR, yes, every day you have to mark. Then your daily pivot or weekly pivot. That's it. Okay. That is what you don't have to mark every day. Just because I've shown you here, mark it whenever you see it. Other times you can leave it. Finally, remember, if there are any events or news in the market, then all these levels may not work. Because whenever there is a news or events, market just moves based on the news and will be very volatile. So keep a track of news events through any news based applications. What actually events news? Events are like anything. Maybe there is an election result. Maybe there is an exit poll. Maybe there is a budget, union budget. Or there may be some war-like situation between two countries. Okay, that is also kind of events. That also can affect market. That can also affect economy. Anything that can affect economy, that is called events. Or if you are trading stocks, if you are trading in some stocks and you know that that stock is coming with its quarterly result on Monday, and if you are trying to trade in stocks, you may get trapped. Remember, that stock will be very volatile because there is a news. Whenever there is a news in the market, it will go like this. Zigzag, very volatile, purely based on the news. Very difficult to trade, right? So that is why I tell my students that it is better to stay away from the market if there is any events are coming up or there is an event is going on in the market, because market will be very volatile and difficult to trade. And on the events day, market purely goes on based on the news. It may not respect any locations. So better to stay away from the market on events day. And how to know events, everything? There are so many applications are available. Like Bloomberg is available, Money Control is available, ET News available. So many things you can download it, or you can follow them on Twitter, or you can go to their Google and you can check if there are any news or events coming up. So that all you can check it. Okay, here what I am discussing here I am going to discuss about how to mark important levels on your chart. Can you see this is August 27th chart? Okay, this is the August 27th, and you can see that this is the 30 minutes time frame, and you can see on this chart some levels I have marked. What actually these levels are? Why I have marked these levels? The first one what you see is PDH, previous day high and previous day low. This is straightforward, right? There is no confusion. PDH, PDL easy to mark. Just mark horizontal line. Better to have different color for your levels, so that looking at the color only you will come to know what is this. So PDH, PDL I mark. Then I mark turning point. Why I mark turning point here? Look at this. Market was bearish. Then it took the support at the CPR. This is where market broken the current day high. So that is what you can say turning point for the next day. This is where breakout happened, right? Then can you see I marked the red line here? What is this red line? Supply zone. What is the supply zone here? Supply zone was on 19th of August. Market was in the strong bullish mode and then faced resistance here and then crashed. So that is what supply zone. That is what I said. Supply zone is where market turned bullish. It was bullish, faced resistance, big crash. More than 1,000 points crash in Bank Nifty. So this becomes your supply zone. The extreme end where crash happened. Can you see after the 23rd, market came, took the support and a big bounce. So that is what demand zone. Because after the bearish move, market took the support and big bounce. So this is your supply zone. This is your demand zone. That is what you can see here. Demand zone I mark, and you can see I marked supply zone. So that is how I mark important levels on my chart. Then you can see here I marked virgin CPR. This is the virgin CPR. Now what virgin CPR I marked it here? Now which virgin CPR I marked it here? This virgin CPR. 28th there was a virgin CPR because candlestick did not enter inside. So what I will do next day, I mark a box like this because that is the important support and resistance. Next day also candlestick didn't enter. Day 2 didn't enter. Day 3 there is no candlestick. Day 4 there is no candlestick. So day 5 also I mark. So if you remember I said virgin CPR important only up to 5 to 6 days. After that you can remove it because it gets weaker and weaker after 5 to 6 days. So that's why this is day 1, day 2, day 3, day 4, day 5. So I mark It was in the day 5, so I marked it. Right? Now you may ask me, oh, there is a virgin CPR here also, 22nd. Why didn't I mark this virgin CPR? For that, next day I marked it. Okay, next day I marked it because it was still a valid virgin CPR. But can you see 26 what happened? 26 late afternoon, you can see that breakout happened. That virgin CPR was broken. So that means once it is broken, it's no more a valid virgin CPR. So you don't have to mark it next day. So that's why I didn't mark it. But this CPR, you can see that there was no candlestick for next 4 days, 5 days. So that is why I marked. So that is what virgin CPR, mark it as long as it is valid, mean there is no candlestick, and that also up to 5 to 6 days. Okay, this is how I marked my chart. 27th, before market opened, I marked it. I marked this level. That's why there are no candlestick inside. No candlestick inside at all, right? Because this is before market open. Before 9:15, I marked it. Now what I'm going to show you, after market closed at 3:30, what happened on 27th? Whether these levels were respected or no. What actually happened on 27th? Let me show it to you. This is what 27th. What happened? Same level which I marked in earlier chart. You can see it here. Previous day high which I marked. Previous day high. You can see it here. Supply zone I marked. You can see it here. So let us see what happened. Can you see 27th what happened? Market opened with a bullish candle and suddenly it started facing resistance at the virgin CPR. This level what you see is the virgin CPR. It reversed from the virgin CPR, took the support from the previous day high, again it bounced, again it started facing resistance, again it came down, again it took the support at the previous day high, again it went up, again started facing resistance, again came down. So that is what the price action on August 27th. Now let us see in the live market what could have happened, what novice traders, how they would have got trapped, how novice traders get trapped, and just looking at the candlestick and they trade and they get trapped. Look at this. Previous day was, look at this, such a huge day, right, in Bank Nifty. So novice trader thinks that today also it will go like this because market opened with a bullish candle, bullish pin bar, right, and they start going long. Because previous day there was a big move, today also bullish candle, they think that it will same thing happen. And they must have kept stop loss below the first green candle. And what happened? It went reverse, stop loss hit. People who went long here, their stop loss hit. What mistake they have done? The mistake was they didn't know about this. There is a virgin CPR. They went, taken a long trade near the resistance and got trapped. There is another kind of trader who is a short seller. What he does, he will short this candle. Why he short this candle? Because huge red candle, right? Such a big red candle. He thinks that, oh, such a red candle, market will reverse, crash. He will short. And he must have kept his stop loss here. Look at this. It came, immediately took the support near the bid edge. His stop loss hit. Right? And again, another short seller waiting for the right opportunity. He will not short anywhere here. He will not short anywhere here. Where he will short? He will short here. Why? Because look at this. After a long consolidation, there is a huge red candle, right? After this, next huge red candle here. Again, he will sell here, thinking that market will go down. And maybe he kept his stop loss above that candle. Again, he took the support, his stop loss hit. So 2 times shorting at the red candle, stop loss hit. Then that trader may think that, okay, 2 times stop loss hit following the red candles. Now I'll not take a short trade. I'll take a long trade. But he will not take long trade near the support. You know where he'll take a long trade? He will take a long trade at this bullish candle. Why he take a long trade? Because he thinks that after a long time, huge bullish candle, he thinks that market will go up. But again he gets trapped. And that is what novice traders always think, that whatever I do, market goes opposite direction. If I go long, market reverses my stop loss hit. If I short the market, market reverses my stop loss hit. Why does it happen? It happens because novice traders, they don't know about all this location. They focus only on candlestick. They think that it is bullish, they should go long. It's a bearish, they should go short. It's a bearish, they should go short. They think that they have to go long. Remember, this is not a place to go long or short, because you are going long near the resistance. There is a virgin CPR plus current day high, that is the resistance. If you are shorting here, you are shorting near the day's low plus previous day high, likely to work as a support, and you are shorting at the wrong time, you are going long at the wrong place, wrong location. So best place to go long is this, near the support, near the support. Best place to go short may be here near the virgin CPR, not here. That is why important is location. Going long near the support can give you good risk reward trade, and going short near the resistance, not the other way around. Okay, so that is what I just wanted to show, how novice traders get trapped by taking trades at the wrong location. And another thing, if you are trading on this day, your bias should not have been another trending day. You should not have expected another huge day just like previous day. Why? Look at the CPR. Look at the CPR width. So wide CPR means it is likely to stay sideways, and that is what happened. Wide CPR leads to most of the time sideways day, so market stays sideways. So on the sideways days, I said what is the best place to enter? Near the first 1 hour high and first 1 hour low. Days high and days lows of first 1 hour. What is the first 1 hour high and low? This is the high, this is the low. That is what happened. This is the place where it came, took the resistance, high, days high, took the resistance, near the days low, it took the support. Okay, so that is how I said you can also trade on the sideways day. It's not that sideways days you can't trade, but you need to have the patience to price to come to one of the range, and you should trade the ranges on the sideways days. And this is your virgin CPR. And for the next day, it becomes your virgin CPR because no candlestick inside. So that is what I just wanted to show you, how locations are important on your chart, not just candlestick, and focus more on the location, and that is how you can get high probability trades. Okay, and now we are going to discuss about the supply and demand zone. What is supply and demand zone? Supply and demand zone, I said, extreme ends where market turned bullish to bearish or bearish to bullish. Look at this. 15th market closed here. This is Bank Nifty chart. Next day it made a huge gap up, right? And from here it started reversing. On 16th it opened with a bullish candle, but then there was a big crash. Look at the crash. Huge crash from top to here. And from this point it made a huge bounce, right? So this is what you are supply zone. Because there is a crash. Okay, huge crash. This is the supply zone. Huge bounce means this is your demand zone. That is what I marked here. So next time what happened? 17, market came here near the supply zone, came under selling pressure. Look at this red candle, and it started coming down. Right? So that means this is the place you should look for shorting opportunity if you see the bearish candle, because that is the supply zone. Supply zone means that is where strong sellers are. Okay, first time it reversed. Second time, can you see what happened on 18th? Again market started going up, and this time didn't reverse. Breakout. This is called breakout. That means, look at this, almost Maribozu kind of candle, except small wicks is there. Otherwise, it's almost like a Maribozu bullish candle. That is what I said. Maribozu candles, normally you will see near the breakout. So breakout happened, it didn't reverse. Earlier it reversed, but it didn't reverse second time. And then breakout happened and kept going up. So that is why candlestick is important at this location. Don't just go long just because you are seeing back-to-back green candle. Don't go long. See whether that level get broken or it reverses. If it reverses, that means it's a shorting opportunity. If it doesn't reverses, breakout means long opportunity. Why breakout means what happens? People who shorted here, they have the stop loss. What is the stop loss? Buy order, right? When they're shorting. Again, people shorted here, again they kept the stop loss. Next time when price started coming here, people again started shorting near that level and they had the stop loss. So, but this time the stop loss got triggered. All buy order got triggered and market started going up. So this is what supply and demand zone. Demand zone is, anyway, demand zone didn't touch. Instead of going up on 18th, if market started coming down, and if you see bullish candle near that demand zone, maybe some pin bar or a bullish candle like this, then this is the best place to go long. Okay, you can take a long trade expecting market to reverse, because last time it made a bounce from that demand zone. So you can keep your stop loss somewhere here and you can take a long trade here. Okay, that is what supply and demand zone all about. I discussed about the swing highs and swing lows, right? Swing high, swing lows on the daily time frame. This is the daily time frame. So where is the swing high? If you are trading on this day, which is the nearest swing high? This is your nearest swing high. Look at that spike on the extreme end. What is the swing low? This is the swing low. This is the extreme end low. So that means next time when price coming near that swing high, you should know there is a likely reversal, because there is a resistance. From that swing high, market comes down. If it coming near the swing low, there is a probability of bouncing from that swing low. Okay, that is what swing high, swing low on spikes, what you see on daily time frame like this. Important support resistance. I also talked about the gaps, right? What is the gaps? This is your gaps. You can see that there was a gap in the month of May 2019, huge gap. This is the gap. So that is what known as gap filling. Many people must have expected market to go like this, but you can see that it came, find the support, finally got filled. So you can see many gaps on your chart. Look at this. This is also gap, right? But what happened? Gap got filled. Within 3-4 days only, gap got filled. You can see there is a gap here. You can see next day itself that gap got filled. So that is what they say, markets don't like gaps. Most of the time, not 100%, nothing is 100% in trading. They say eventually gap get filled. Look at this. This is I'm showing you on 30 minutes time frame, just because to show you how borders, gap border work as support resistance. Okay. Otherwise, I said gaps has to be seen from the daily time frame, but just to show you support resistance on the gap border, I'm showing you on 30 minutes time frame. 9th was a gap up, right? Why it was a gap up? Because 8th high was here, low was here, next day market opened here, made a gap. So this is what gap, and this is called gap border. Lower border, upper border. So next what happened? 9th was a very bullish day, market went up. Then next 2-3 days market stayed sideways. Then 15th market came down, and look at this, where it took the support. Almost to the gap border, because that was a support, upper border. Took at the gap border support and bounced, right? And gap got filled on 17th. Look at the 17th candlestick. Exactly point to point. Exactly took the support at the gap border and made a bullish candle. And gap got filled. So this gap got filled on 17th. That's why they say market fills the gap most of the time. But remember another thing. For example, 15 market started coming down. Don't short here, expecting that it is going to fill the gap. Before gap getting filled, most of the time I've seen it is taking the support from the gap border. So don't short until this broken. If it is broken, then only you can short. Otherwise, even this could be long opportunity, because this is the support. This also support. So that is what gaps, you've seen how nicely it works as a gap border. But remember, what is gap? This is not a gap. This is not a gap up. Why? I said gap up in above the previous day high, previous day low. 6th was, this is the previous day high, this is the previous day low. Next day you can see that candle inside that previous day range. So this is not a gap. So that is what you should see, that gap mean entirely outside the previous day high and low. Now we are coming to the last slide of the first session, where I said Nifty, Bank Nifty moves in tandem, right? I said moving in tandem that means if one of them have a support, it bounces, another one also can bounce, or one of them have a resistance, reverses, another also can reverse. That is what I said Nifty, Bank Nifty most of the time moves in tandem. So look at this chart. This is a March 27 chart on 5 minutes time frame, Nifty, and this is Bank Nifty. Just look at the price action for a second. Look at this, almost exact ditto photocopy, right? Almost you can see same kind of price action in Nifty, Bank Nifty both. If you don't know that this is Nifty, Bank Nifty, you may think that, oh, both are same chart. No, both are not same. This is Nifty, this is Bank Nifty. And the whatever you are seeing here, the black dotted line, this is the previous day high. Okay, March 27th, what happened? Market, Bank Nifty broken the previous day high here, and Nifty also broken previous day high, right? So if you are trading Bank Nifty, what you would have done? You would have gone short here, because Bank Nifty broken the support. You must have kept your stop loss above the previous day high. Your stop loss was somewhere here, and your take profit will be here. Why you keep take profit here? Because you know that CPR works like a magnet most of the time. Price gets attracted towards it. From this candle till the CPR, there is no support. You think that this is the best place, you can short and take profit here. But you know what happened? It came here and already you were in very good profit. Your entry was here, this candle, and already you were in very good profit, right? But it didn't touch your CPR. Before that only it reversed and your stop loss hit. And your stop loss hit. Had you not booked your profit here, your stop loss hit. From the profit, you went into the loss because you didn't book your profit. You waited for CPR, but it didn't touch. What could be the reason why it reversed from here? Now look at the Nifty chart. Look at it. Nifty was at the CPR, even though Bank Nifty was not having CPR support. Nifty suddenly reversed from the CPR, and Bank Nifty also reversed. That is what I mean to say, moving in tandem. So that means next time, if you shorted here, even though you kept your take profit here, but you see that, oh, Bank Nifty reached here, but Nifty is already at the CPR, it is good to book your profit here. Don't wait for CPR. Book your profit here, because anytime Nifty can bounce. Okay, so that is what I mean to say. Look at both the chart. You can see here, again, you can see Bank Nifty came here, didn't touch the CPR, huge bounce. Why? Because Nifty took the support from the CPR and bounced. So that is what you need to keep a watch on both the chart at the same time, because most of the time it moves in tandem. Okay, so that's it about the first session. Okay, basics, introduction, everything we discussed about the pivot point, CPR, price action in the first session. And second session is going to be the another important session, that is 15 patterns and strategies.